Traders, you are now examining a chart illustrating the S&P 500 ETF, also known as SPY, on the daily time frame. Friday's session concluded with SPY closing below both the 5-day and 10-day moving averages, heightening the likelihood of a test towards the 20-day moving average, currently situated at 507.18. Notably, Friday's low for SPY reached 508.12, closely aligning with our previously provided target of 508. Thursday, at the end of day before the market closed, we shared with option traders within our group that we had bought the SPY 506 puts, resulting in a double at the open on Friday. On Friday, the S&P 500 commenced trading with a notable decline, marking a significant downward move of over $50, translating to a decrease of more than $5 in the SPY. This movement resulted in profitable outcomes for those who received the SPY trade alert. Determining the SPY's impending gap down involved a nuanced analysis of several technical indicators. While absolute certainty in market movements is elusive, certain indicators pointed towards a higher likelihood of a downward gap. For example, the on-balance volume, OBV, recently breached a crucial support line that had previously provided price support over the preceding weeks. Also, the Relative Strength Index, RSI, also descended below its support line, which had previously acted as a stabilizing factor for price movements. Such divergences from established support levels frequently support short-term price corrections in the market dynamics. The present wave, which I identify as Wave 5, indicates a potential reevaluation of the long-term breakout observed in the substantial cup and handle pattern on the weekly charts. This suggests a potential move to retest the 460 to 450 area. However, it's important to note a discrepancy with seasonal patterns. While historical seasonality indicates that January and February are typically among the weakest months for the S&P 500, we've observed historical gains during these months. Therefore, relying solely on historical references may not fully align with the anticipated trajectory in the upcoming weeks, particularly if we witness the development of an ABC correction wave during this period. The SPY is currently positioned below its 5-day and 10-day moving averages on the daily time frame. Notably, the 20-day moving average stands at 507. A close below this level might trigger another wave of selling pressure. Additionally, the 50-day moving average looms as a potential target, situated within the range of 494 to 500, further indicating a bearish sentiment in the market. The current trajectory of the 20-day moving average indicates an upward trend, and price action continues to acknowledge this critical level. As long as this dynamic remains unchanged, the likelihood of further upward movement is favored. Historical analysis since January reveals a pattern where the S&P 500, SPY, has consistently found support and generated favorable buying opportunities upon touching the 20-day moving average. However, there is one notable consideration, best observed on the weekly time frame chart, indicating that SPY formed an inside candle pattern, suggesting the likelihood of a substantial move in the upcoming week. Additionally, concerns arise from the fact that the price has significantly deviated from the ascending 20-day moving average, marking the furthest distance from it in years, and suggesting an increased probability of a mean reversion. To see how we navigate the upcoming corrective wave, investors may wish to consider joining our live trading group for a nominal monthly fee. Join us on our Patreon page. On the 2-hour time frame, we observed several technical indicators signaling potential shifts in market dynamics. The RSI 5 has recently dipped below the critical 30 mark, prompting our attention towards a decisive rebound above this level, indicating potential buying pressure. Meanwhile, the RSI 14 has breached the 50 level, currently resting at 44.13. with a neutral outlook on whether it might cross back above 50 in this time frame. Additionally, the stochastic oscillator is exhibiting signs of a bullish crossover, suggesting potential momentum building towards the upside. Given the current scenario where the price has dipped below the 10-day moving average, a customary sell signal has been triggered, indicating a bearish trend until the price regains strength above this widely tracked moving average. With each descent below the 512 level, the likelihood of further downside momentum intensifies. Presently, our trading group holds put options at the 500 and 506 strike prices, anticipating a potential retest of the 500 level. In the event that the price fails to reclaim the 511.8 level, we intend to augment our position. Conversely, if the price manages to close above the 512 level, we will exit our short position. Considering Friday's quad witching, where various futures and option contracts expire simultaneously, the heightened volume is somewhat expected and may not signal significant market sentiment changes outside of the quad witching phenomenon. Notably, the last occurrence of the 20-period moving average crossing below the 50-period moving average on the hourly time frame preceded a substantial gap up the following day. Presently, the configuration of the RSI 5 and the 25 and 50 moving average alignment mirrors that of the previous occurrence. However, it's essential to maintain objectivity and let price action dictate our actions rather than imposing biased expectations. Ultimately, price movement remains the ultimate arbiter of market direction, and we must heed its cues accordingly. If price action mirrors that of February 22nd, we now observe a significant confluence of resistance at 512.24, where the 50 and 20-day moving averages intersect. In the event of a breakthrough beyond this confluence, additional resistance zones await near the 513.59 and 515.78 levels. Conversely, should the current pattern resemble a bear flag formation, the projected move suggests a retest of the 200-day moving average around 503.78 on the 60-minute time frame. This scenario aligns with my anticipation, considering the presence of a notable unfilled gap attraction between 501.5 and 496. For Monday's trading plan, if we see a gap up, we will be looking to add to our 500 puts near the 512 level. Should price fail to hold that level, otherwise, if we see long candle wicks under the candles at that level and a surge above 512, we'll close our puts and go long for a retest of the 515 level. To follow our trades in real time every day, visit patreon.com/soratrades. The 20-day moving average is still pointing up and price is respecting that line. That being said, there is one caveat, and that can be found on a chart of the weekly time frame, which shows that the SPY printed an inside candle on the weekly, suggesting that an outsized move is coming more than likely next week. Also of concern is that the price is far away from the rising 20. As a matter of fact, it is the absolute farthest it has been above the 20 moving average in years, with increasing odds of a snap back to a mean reversion. Also, the relative strength index is at 76.31, which is also the highest reading also in several years, with the on-balance volume diverging from price and already heading lower despite the new all-time highs. And that brings us to a close for this video. However, before we go, we'd just like to mention that if you would like to receive our trades in real time as we make them, be sure to join our Patreon, which you can find at patreon.com/soratrades. Thank you all so much for watching, and if this video resonates with you, be sure to take a moment to leave a comment below and share this video with your friends and colleagues. And don't forget to like the video. Until we meet again.